Starting strong, we're here today. Jim and Ryan lead the way. Talking money every day. Mastering the mind's array. Dreams of wealth within our sight. Building futures burning bright. Financial talk that feels just right. Learning, grow, rise to new heights. Money mindset mastery time. Listen close and climb the line.
I saw you TikTok dancing there, Ryan, for a second.
That's right. Only available for those watching us. So
Yeah. Well, I'd like to welcome everyone to the Money Mindset Mastery podcast. I'm your host, Jim. Joining me today, as always, is my partner in crime, Ryan. Ryan, how are things today, aside from the TikTok dancing?
well, you got to keep it alive, right? So
Yeah.
great day, and a lot of clients have been asking a lot of questions around what we're going to talk about today. And so we were talking, you and I, and we thought we'd bring in the experts to talk a little bit about, real estate, the interest rates, and how they're going to affect people and how to prepare for them. So that's why we got John and Sonia here today.
And Crystal Ball is still delayed as well, so we can't really give any predictions, but we can kind of help people, guide them into what may or may not happen. So you're absolutely right. We've had a lot of people ask us about real estate investing, the current interest rate environment, and we thought we would bring in the experts. So today we have my partner, John Sowerby, mortgage broker at TVH Mortgages. John, thanks for joining us today.
My pleasure.
And also business partner, lawyer, Sonia Kosoper at TVH Legal PC. Sonia, thank you for joining us as well.
Hello. Always a pleasure.
And not only are you both in the business of real estate, but you're also real estate investors. So you're also able to provide a perspective as investors as well. So the real estate market has been a little bit crazy over the last couple of years. And I'd say crazy in the opposite sense, because for a period of time, everyone is getting into real estate, doing really good in terms of their appreciation of value, just a really strong asset class for many people. And because of some recency biases, we've had clients come to Ryan and I saying, is really real estate still a good investment long term? And we still believe that it is. And we'd like for the two of you to help out, kind of, explain why it's still a really good investment today and long term. And there might be some opportunities now as well, because the interest rates are starting to adjust. So now we're starting to see the interest rates kind of coming down in the opposite direction, which is wonderful. So I'm just going to throw it out there right now and throw this first question out. Is real estate still a good investment, guys? John, what do you think?
I would say yes. I think that, like all investments, it's important to put it in its place, and it's important to recognize that it's probably not a good thing to be all in, but if you leave it outside of your portfolio, then you run an equal risk of missing out. I think one of the things that ultimately appeals to people about real estate is the first part of the name, that it's real. You own it. It's something you can go and you can touch. It's tangible. You think about anything from speculative investments like crypto, where you don't have that option, all the way through to even shares in a company, which again, a little bit more concrete. But if anything went horribly wrong with your financial portfolio, you couldn't live in your RSP, but you could potentially live in an investment property. So the bottom line is, I think it's just understanding that we had a heck of a run in Canada over the last several years. And so people start to pencil in that they're going to have that kind of return every year. And I think that's the first thing you learn about investments is, past performance is not an indication of future performance.
Sonia, any comment on that yourself?
I'm a big believer in having real estate as your overall portfolio. And I continue to look at real estate. I advise clients to, consider real estate as part of their overall financial plan, because it just makes sense for most of us. And if it makes sense for my clients, then I'm happy to discuss that option. But I think investing in real estate is always continues to be wise.
Yeah, I agree. And in terms of what we've dealt with interest rates and inflation over the last couple of years, what has been the impact to specifically real estate investors? And we can talk about individuals who bought, within the last couple of years. We can talk about individuals who bought 5, 10 years ago. We can talk about pre-construction. What has been the impact in some of those examples?
Well,
Well,
it's a pretty wide, category, and a lot of those examples could be standalone examples where you could probably do a standalone show. I use pre-construction as an example because that's one that's going through a lot of ups and downs right now. But I'll sort of go with your idea of sort of the people who've been in for maybe a little bit longer, 5 years, 10 years. And I mean, that's the old adage with real estate, right? The best time to buy real estate is 20 years ago, and the next best time is today. And I think that in most of those situations, people who have purchased real estate, call it 10 years ago, yes, we've probably seen some rollback in pricing over the last 12, maybe 18 months. But for them, probably on top of, I don't know, a doubling in price over the previous 8 or 9 years. So, first on capital appreciation, they've done quite well. Secondly, they've had, 9 or 10 years of growth with regard to rent, even though we are in a position where the underlying price of the asset is quite low because of some surprising, well, maybe not surprising developments with regard to overall availability of housing in general. Rent is quite high. So if you're in a position where you've had some client turnover, if you bought that property on an adjusted basis 10 years ago, and you've probably doubled your rent since then, you could be sitting quite well. The one thing, again, like any longer term investment, is you look at an investment in real estate over the long term. And if you've been in for a while, chances are you're in pretty decent shape, even if maybe on paper you're not doing as well as you were, say, 24 months ago.
And I know one area that I've heard of a lot in the media, and I've actually talked to some people who are in the business, in the development business, where the condo market has been a major challenge, specifically in downtown Toronto, GTA area. What's the reason for that? Can you guys share why that's happening?
Well, the reality is that new condo sales in the GTA have actually slowed to record levels. Like over the last 20 years, we haven't seen them this slow. 3,200 condos sold in the first 6 months of 2024, which was like a decrease from about 50% from the previous year. So we've seen just considerable slowdowns. Unsold inventory, record highs, 26,000 units. And most of these are pre-construction condos. The reality is that the price point has actually not decreased that much, although we are thinking that the condo market is much more reasonable to get into. The prices have actually gone down only 2.6%. So affordability still becomes an issue for a lot of people. And then the reality of it, they're just too small. It doesn't fit people's lives anymore. So they're not buying into this. And the affordability portion is purchase price is still too high. Interest rates are too high. They just can't get in. So they're just not buying them. And the pre-construction units, a stat compiled by Urbanation, said that 40 condo projects have just halted, that were set to launch, just pulled back. So there just isn't the inventory out there as well. So from that perspective, it's a real financial consideration that clients are making and buyers are making, and not pulling the trigger to go into.
So does that mean there's an opportunity here specifically for young first-time home buyers?
I would say so. Like in light of this, I would say that there is an opportunity to get into it, but the affordability component has to be there and has to be solid.
And is that because of interest rates from the affordability point of view? Is that the challenge?
Done?
Well, the interest rates are a part of it, but there are ways to address that. Term choices, whether it's a shorter term or a variable rate term. We are now fully in the zone of rate cut territory. We've seen 3. We expect to see another in a few weeks. We'll likely see another in December before the end of the year. Keep in mind, 90 days ago, we weren't sure if we're going to see 1 or 2 before the end of 2024, and now we're probably on track for 5. That is going to make a difference. The trick here is, again, always sort of over any reasonable time frame, and I don't typically define a reasonable time frame as 12 months when you're talking about something like real estate, because as Sonia pointed out, a number of these projects now are shutting down. That's not necessarily going to impact us today, but when we get to 2027 or 2028 and those aren't sort of being rolled out, if we've seen a little bit of an uptick in purchasing, you're going to be right back to where you were maybe 3 years ago, where you were having 10, 20 people show up on offers night, because we're going to be back to where we were with regard to a supply issue. That, I think, is the most difficult situation right now. Is it's like driving a car and oversteering. You know, you're on a road, things are a little bit slippery, you start to feel yourself drift. You pull the steering wheel a little bit too far, you realize you've overcorrected, now you're trying to pull back the other way. That's where we are with this business, because again, those new construction condo units, it's difficult for them to drop their price, because if they do, when people go to occupy and register their mortgages, if you've sold 2 units which are functionally the same, but you sold one at 600,000 and one at 550, when those units go to get appraised, that person who purchased at 600,000 is going to have a potential serious problem closing on that. That's not good for anybody. So they're incented to try and hang on to it. Now, you might get some top ups with regard to the kitchen counter you buy. You might get a bit of a top up in terms of the flooring, but they're awfully hesitant to drop that price. Now, in terms of getting in, I think the best part for potential buyers is that you're not dealing with multiple offers. That's where things got very difficult for people. That's where people put themselves in bad financial situations. It is far more of a buyer's market in the condo side right now. That gives people the chance to sort of really do their due diligence, put in an offer, oftentimes conditional, which is something that for the better part of a decade we didn't see in that space. And ultimately, give them a chance to get in a more responsible fashion. And I think that that's where the opportunity is, because at the end of the day, is it a fire sale? Have we seen prices cut in half? Are they just giving them away? No. And the reality is, given the population growth in the country and given where we are with regard to the ability to build new units, which is quite limited, that is unlikely to happen. So what's your next best step? It's trying to do what you can with what you've got. And right now, the chance to get in a more responsible fashion is probably the real opportunity for most of those first-time buyers. So I think that is what we really have to keep in mind, that we're not necessarily going to see these things go to, 10% or 20% of where we thought they should be. That's just economically not feasible for anyone who's involved on the sales side of that transaction.
Yeah, and I've been speaking with, again, some younger clients who have been looking into getting to real estate. It's been a challenge for them for the last few years. And I'm seeing, and tell me if I'm wrong, a bit of a window of opportunity right now, because it seems to me that a lot of these units that are for sale, to Sonia's point, you're not really seeing a significant reduction in pricing. They're holding their prices. And I'm wondering if they're holding their prices because they're anticipating that by springtime, interest rates will probably be down further than they are today. And at that point, we're going to start to see more people entering the market again and potentially start to see those multiple bids and whatever else. Is that reasonable to think that?
I know Sonia tends to be on the back end because, again, as the person who works on the financing side, I tend to be the first person who gets contacted when people get back into the market. We've absolutely seen a pickup in sort of late August, early September, after almost no market in the spring, which is typically not the way things go. Usually the spring is the most robust market. We have definitely seen more activity. I would say maybe up 20%, 25% from where we were. We have some new rules coming in from the government with regard to what can be financed. Maybe not a big impact in some of the more rural areas or areas where houses maybe didn't get as expensive, but in places like Toronto, Vancouver, bigger markets where price tags have been significant, we're probably going to see it a lot easier for people to get into the market. They're moving up the price cap on minimum down payment mortgages to $1.5 million in purchase price. That is going to have an impact, especially in places like the condo market, where if you're going to have anything more than a 1-bedroom and den, you're going to be flirting with that $1 million price point. At the end of the day, it's always so difficult to tell exactly when the timing is going to hit. But my usual suggestion, I think Sonia would back me up on this, is when things turn, they tend to turn very quickly. And what will happen is you'll have half a dozen maybe couples watching a unit, and the unit gets listed at $1.2 million, and then it goes down to $1.15 million, and then $1.1 million. And the chatter is, if it gets to $1 million, we'll jump. And then at $1.05 million, someone jumps. And then those 5 other couples look at that and say, oh, didn't expect that. And then someone gets a little bit concerned that maybe we bottomed out. And then you see, like dominoes, things will start to fall. So every time that rate gets cut, and now the next discussion is, will it be a full 0.5% in October? The pump is effectively primed. There are buyers out there. There are people who are tired of putting their lives on hold. There are people who want the extra bedroom because they want to have a child, or they want to, downsize, or whatever it is. At some point, that's going to kick off. And when it does, it'll probably be pretty quick. And every time we get a little bit closer to, bringing the rates down, to bringing that affordability level down, we get closer to that happening.
And I know with the government, they're looking at reducing immigration as well, or slowing it down. Do you think that's going to have any impact on the market moving forward?
Yeah, I think that there's no doubt that, again, if you take a little bit of the demand side away, but the problem is we need immigration. Maybe we don't need as much as we've currently got, but we do need it. We're a population that has a very low birth rate. So the simple fact of the matter is, we're not having enough babies. So how do you address that? You bring people in. Canada certainly has its issues, but it's still a very desirable place to be. And as a general rule, we have little trouble attracting people who want to be in the country. So yes, they might cut that down. Will that help? Sure. Is it going to make it a completely different marketplace? I don't know that that's necessarily the case. Now, some people might point out, and I think it's a little bit short-sighted to point it out this way, those aren't necessarily the people who are buying properties. And that's probably true. If you have a student who comes in from, Asia or Latin America, who's staying here for a couple of years to do some form of education, they're probably not buying a house. But they are going to need to live somewhere. And perhaps the person who bought that house is an investor who then rents it out to them. So again, it is a knock-on effect. So the bottom line is, taking a little bit of that off the top will help, but I don't think it necessarily solves the issue, because the issue is still quite significant.
Okay. And so I think I want to switch this a little bit on from a legal point of view, because there've been, again, conversations that I've had with people who work for developers, and there have been some challenges with people closing on pre-construction sales primarily. So maybe more from your point of view of what people might want to consider in the future if they are looking at pre-construction sales or to purchase on the pre-construction. So I'll give you an example. I know of some clients who've actually purchased pre-construction, where the builder that they bought from, they were basically told by the builder, here's your closing date, you need to close, and if you don't have the money, that's your problem. And people are struggling and walking away from these deals. I also know of other builders who have basically have offered to sell them a smaller unit. So that way they don't lose their deposit, they still walk away with a piece of property. But yet there's always this threat of lawsuits against the builders. Is there any out for a purchaser on a pre-construction deal at all? Or is it you've signed the agreement, you have to deal with it, you have to close? And maybe Sonia didn't hear any of that question.
I can't hear you any longer, guys.
You can't hear us anymore? Well, probably earbuds probably ran out. All right. So no one else can really answer that question because we're not lawyers. So where do we go from here? Ryan, do you have any questions? Maybe you can ask John.
Well, I guess everything that we've talked about, plus when it comes to the real estate market too, and the way people prepare for buying a house, you know, the interest rates. You know, there's two conversations that we can go down to, which is how do people prepare when their renewal is coming up? I think that's a big question. You know, for us, Jim and I, right now, it's about preparing people for what is potentially a doubling in their current mortgage, right? So how are you navigating the conversation with people on top of working with us when it comes to clients, when it comes to the markets itself and the interest rates?
I think one of the most helpful things is to try and be out in front of it to the greatest extent possible. The point I make to people, and sometimes they'll say, well, gosh, John, we're not renewing for 3, 4, 5 months. Why are we having this conversation now? And the reality is we don't necessarily want to get away from the current pricing on whatever rate they have, because perhaps it's from, you know, some years ago when rates were a fair bit lower. But are there things we can do today to prepare for it? Absolutely. People sometimes mistakenly think that rates are either very, very stagnant or they're moving all the time. And it's typically sort of a little bit of in between. And where one grouping, for example, fixed rates, which typically prices off the bond market, something like variable rates, which typically prices off of the money market, the Bank of Canada are, may not always be the same. So one of the things that we're talking about with people right now is giving some strong consideration to a variable rate, because a variable rate will allow you to participate in future rate cuts, with the idea being that if you take a 5-year variable rate, you may not necessarily end in a 5-year variable rate because you do have the right to convert to a fixed. But until we see those fixed rates bottom, you don't necessarily want to jump on the fixed bandwagon. But here's the thing. 6 months ago, nobody wanted a variable rate. Why? Because variable rates were high. And so what did lenders do? They offered what they call a discount of some significance to get people to accept variable rates. So if the prime rate was 7.2%, they might have asked, 1.2% off. So your contract rate would be 6%. Well, as rates start to go down, 1.2% in discount has maybe become 0.6% in discount. So with where we are right now, 6.45% in a variable prime rate, that 0.6% is only 5.85%. So you're only saving 50 basis points relative to where you might have been 6 months ago. Mm-hmm. We have the ability to lock in those discounts up to 4 months out. So being ahead of the curve, recognizing that you probably want to at least give some serious thought to starting in a variable, the sooner you get something like that locked in, the better off you're likely to be if you decide to stick with a variable. And those are some of the things that we can do up front. That again, it's always better to have more time than less time. If ultimately you want a fixed rate, you're probably best off to try and hold out as long as possible, because again, fixed rates are continuing to come down. But right now we see that they're coming down at a slightly slower pace, because now as the market starts to accept that maybe things are a little bit worse than anticipated, a lot of those cuts have already been priced in on the fixed side. So again, where does that leave opportunity? That's a conversation for us to have based on people's risk tolerances, based on what they accept and what they sort of, can deal with. And all of that to me suggests a little bit of planning done a little bit in advance is generally better than flying by the seat of your pants at the last minute.
Yeah. And I think we've talked about this on other episodes too, which is likely about 6 months out is when you should start maybe collecting the data, start talking about it with you guys and the TVH Mortgages team. Even on our side as advisors, we're recommending that we're starting to have, and not waiting for, whatever the first offer that comes in from the bank or the institution, which can often leave you paying a lot more than you anticipated. And
what's that, Ryan? The bank not necessarily giving you the best offer the first go around with lots of time to consider and shop?
Yes.
Say it ain't so.
Yes. So, Yeah, absolutely. And again, for having worked with your team, is taking other things in consideration instead of the banks very much. We just want a quick sale. We just want a quick turnover, and that's it. It's with the group, the TVH group. It's about the relationship and understanding what your longer term goal is, on top of whatever maybe short term goal is, and whether we're talking about buying a primary residence or we're talking about a secondary investment property. I know John, yourself and the team takes all those things in consideration. I know Sonia, I've heard her over the phone talking with clients too about understanding their goals, short term and longer term, versus just a transactional piece. So,
And I know Sonia and I talk about this a lot because obviously we work a lot hand in hand with clients, joint clients, etc. And the point I would make is I think Sonia and I, who are also both property investors ourselves, are also very aware of our own biases. So when we sit down with clients, we're happy to present them with options. We're also quite happy to say, you know what, this is what I might do. I don't know if this is necessarily what I would advise that you do. Because oftentimes, and you'll appreciate this, a client will say, you know, John, Sonia, what would you do? And I say, you know what, here's what I would do. But when I talk to you and I hear your risk tolerance, etc., we're not at the same point. So, you know, with that in mind, let's set aside what I might do and let's talk about what I think perhaps you should do. And again, that is, you know, the benefit of having a lot of personal experience ourselves, both with our own investments and with our clients' investments. And I think that just like you guys, you know, every situation is a little bit different. You really want to avoid that cookie cutter approach because inevitably, you know, things get missed.
yeah.
Yeah, we brought up
It's
that point
definitely-
actually. Go ahead, Sonia.
When my headset malfunctioned, I was trying to read your lips, but I couldn't do it fast enough and trying to deal with my technology.
It was like the
But,
most epic question that I asked ever in the history of my life, and you
I
just left me
missed
hanging.
it.
I'll
You
re-ask it
re-asked
again. I will
I'm
re-ask it
here
again.
now.
But what I was gonna say was a lot of our recent podcasts. We've talked about how the reason why TVH Group started was going back to, again, the biases and non-biases, right, John? Like, you were definitely heavily biased on the real estate side. I was heavily biased on the investment portfolio side, and you were the one that had said to me, you know, I know that this is going to be my bias in meeting a new client, and I know that that's going to be your bias. However, if we come together, we eliminate those biases. Now it really does come down to what's best for the client, what is it they're looking for, and what is it that they should do best on their risk profile, and so on and so forth.
I came
So
along and created balance.
you did.
Ta-da.
I created a balance between the two. See that?
You created the balance and kept us out of trouble, right, John?
Well, I think it's also worth mentioning, you know, all of us have become property investors as a result of sort of, you know, walking the walk. All of
Yeah.
us have, you know, worked with you on, you know, proper insurance, proper investments outside of real estate, et cetera. So, you know, it's one thing to talk about it, it's another thing to do it. And I think that over the years, you know, we've blended that to the point where, again, the balance was created. I think we've become much more aware of ourselves as investors. And the result, it's a lot easier to sit down with people and help find a good path for them, because again, not everyone is the same, you know, and that's just the bottom line. So the more you recognize that you don't know what you don't know until you start to know, the further ahead you'll be.
I agree. And before I re-ask Sonia the question, John, but I don't want to forget this question, because this comes up quite often. Are you finding that the renewals that clients are offered through the bank, are they competitive with you potentially looking at other options for them with another provider?
It depends on the situation is the short answer. I'm gonna sound like a bit of a lawyer myself. And what I would say is this, sometimes the renewals are very fair. And if that's the case, we usually encourage people to touch base with us because we'll be able to tell them very quickly if they have been treated fairly. And sometimes it might be a fair renewal, but it no longer fits the circumstance. So for example, we're still dealing with COVID tidy up, people who had incurred debt, etc. one of the best times to address that is at renewal. And even with rates coming up compared to where they were, oftentimes if people have incurred credit card debt or other unsecured debt, by wrapping it all together, we can actually still improve their cash flow situation, even though rates are currently higher. That's not something typically that a bank tends to look at. So, my point is it really does depend on the circumstance. I don't want to give anyone sort of a pat answer and say, yeah, you know what, if you're not doing anything to your mortgage, just take care of it with your current lender, because the reality is, you should be taking a look at things. You should touch base with me and let me have a look. The reality is, that's what I do. I look at things, I figure out if the situation is good, if the situation could be improved upon, how I would do it. And when I go through things, just like you guys with cash flow review or Sonia with legal opinions, I explain my reasoning. And one of the things I actually really enjoy is client interaction. So having the conversations with people, showing them the logic, etc. And the bottom line is, I think most people will ultimately look at it if you've done the work and say, yeah, you know what, that makes sense, and move in the direction of the suggestions you've made. And a lot of times, unfortunately, if you're just going back to the lender for a straight renewal of your existing terms, all of that can very easily be missed.
Sonia, it's time for the question again.
I'm nervous now.
Can you hear me? Can you
I
hear
can
me?
hear
Sonia?
you now. I won't ignore you again, Jim. Sorry.
No, don't worry about it. So really, the question was more in preparing people moving forward on pre-construction purchases, because we've had a lot of people, investors, clients who have purchased pre-construction with the intent of not necessarily closing on the property. They were going to sell it off on assignment, right?
Mhm.
And I've had personal friends who have bought homes with the intention of moving in, and some of the builders, they have said to them, you need to come up with the money and financing or else you lose your deposit. I know other people who work for some builders who those builders have actually approached the clients and have said, we'll offer you a smaller home or smaller condo. So that way you can qualify for the mortgage. So that way you're not losing your deposit and you're still walking away with some real estate. They don't have to do that, right?
That's
But
kind. I don't know
Yeah.
many builders that are doing that. So
well, I know of two, based on again connections that I have, and it's the builders approaching the clients, helping them to make sure that they don't lose their money. Bottom line is this: because some of these builders who are refusing to, or even with the builders that are kind enough to offer them something a little bit smaller, they're being threatened with lawsuit and litigation from the purchaser's lawyer, right? Is there any out for those individuals, or are they literally just wasting more money at the end of the day? Or is there something that they can do to get out of those purchases? I think I know the answer, but I'd rather hear from a
gosh,
lawyer.
the short answer is no, absolutely not. There's nothing you can do. And I always caution my clients who are buying pre-construction. Please review the agreement because it is the holy grail. You need to know everything that it says. You need to know all the additional fees that it's going to cost. You need to address all your negotiations now. So I always encourage them to come visit me, have me review it. I prepare a thorough memo. I tell them everything they need to know when it comes to what the bottom line is going to be in certain scenarios, such as occupancy at final closing, should they need to exit, terminate, anything like that. And they get the full picture of what is going on with their agreement, because this might come as a surprise to most people. Everything is in favor of the builder in that agreement, and nothing is in favor of the buyer. You have to comply with every single thing that's required of you under there. Sometimes the things are ridiculous that you need to comply with, but it's there and you need to comply with it. Even if you didn't know it, you can't say, well, I didn't know, because it was there in writing. And the builder will hold you to it and litigate, and they will win because it was clearly provided to you, ample notice, full knowledge. There was no coercion in entering the agreement, etc. So the agreement is the holy grail when it comes to that. So I say due diligence. Do your due diligence. Review those agreements. Make sure that this is right. Actually analyze. How long is it going to take? There's a form at the end of the agreement of purchase and sale. It's the Tarion warranties. and it says, this is when your condo will be built, and this is how far we can push out this condo to be completed. And sometimes they differ by 3, 4, 5 years. So you're waiting, say this condo is supposed to be built in 3 years, it can be built in 8 years. What is your life going to look like in 8 years? Do you still want this condo? Make all those considerations, take all those factors into play, because you may not. You know, you may think this is a great idea right now and you're so excited about it, but even 3 years from now, a young person's life changes so much, right? And those are like all of the considerations that they need to make. So due diligence, consult with your lawyer, especially when buying condos. You have a 10-day rescission period. Please consult with me in that period so that I can let you know if this is actually the right option for you. For many people, pre-construction condos are the right option because of their financial goals. Great. I come with my own biases. If this is going to be your first time home, I have other things to say to my clients when it comes, you know, to whether or not this is right for them. And we walk through all of these steps together. But at the end of the day, it's got to make sense for you financially, because sometimes all of those extra costs pop up. And I had a client recently who closed final closing. They had to come up with $80,000 more in closing costs that they were not expecting because it wasn't itemized. It was just a blanket additional extra fees at the end of the day. So $80,000 for someone who's already trying to scrounge up with the deposit and everything else is a considerable amount of money that they didn't know they had to come up with. So I try to help my clients limit those extra costs, limit those risks so that they know exactly what they're getting at the end of the day.
Great.
So is there any way to avoid litigation? There isn't.
No.
Well, even on a wealth side, when you're putting that deposit down, you know, that's money locked up. That's now was originally you thinking a year or 2 years is now looking down the road at 8 years. It's locked up. That could be doing something else for you as part of your overall plan. So yeah, big thing to think about when it comes to pre-construction. So.
But even with that,
recently legislation came out that the builders now have to apply interest to the monies that they have on deposit, but it's so considerably less than the interest that you could be making in just a reasonable investment that
their investment must be in the bank at their high interest savings accounts.
Yeah, exactly.
That's right.
yeah, but I guess on the flip side, there was a period of time that even if your money was on deposit, you weren't earning anything and it was sitting there for, call it 3 years, 4 years, they were still ending up with a real estate asset that was worth way more than what they paid for by the time they closed, right? So that would kind of offset some of that. I think that's maybe shifting a little bit. It's definitely shifted over the last couple of years. It might be shifting moving forward slightly. But that's where people would justify it's like that's okay if I'm not making anything on it, because when I walk away, I'm going to be up a couple $100,000 or whatever that amount is, right?
Well,
True,
and
but
if you look at the, sorry, go ahead,
Go
sorry.
ahead, John. No, go ahead.
So if you look at the average over the last 40 years, and I'm excluding sort of the COVID period just because that was a little bit more volatile because we had granted a rollback in the last year or two, but we also had a really big run at the beginning of the pandemic in 2020 and 2021. You know, the average is about 5% a year over the last 40 years. That's a higher number than I like to use when I do my own projections. I typically run somewhere around 2.5 or 3%, sort of a little closer to inflation. But simple math, if you buy a $500,000 condo and you can put down 20%, which is $120,000, you know, that's 600,000, or did I say 500 or $600,000? Forgive me.
500.
So $500,000 condo with $100,000 down. If it's a 5-year wait at 5% per annum, I'm not going to try and compound that in anything other than simple form, but that's 25 grand a year. You essentially make back your deposit and then some over that time frame. So, you know, over any reasonable time frame, looking at regular averages, that's still not crazy. And to be clear, one of my biases, I am not a big fan of new constructions. I've done it several times myself. So, you know, gosh, John, why do you keep doing it? That's a fantastic question. But the
You're not
reality
listening to
is,
me.
I'm not listening to myself, Sonia, geez. But the bottom line is, for a lot of people, it does work out. And that's because on the law of averages, it tends to play to, sort of, what's just making sense. And the big one with real estate, and people forget this, is it's the leverage. It's because you're making 5% not on the $100,000 in deposit that you made, you're making 5% on the $500,000 in purchase price. The problem is when that swings the other way, then leverage gets nasty as well. So if you're losing 5%, you're not losing 5% on the $100,000. So you're not down 5 grand, you're down 25 grand. And that's where I think the last couple of years have been particularly painful for people, especially if timing was such that they bought perhaps at the peak. And it's what is it, Murphy's Law? Normally every time they have a build, it gets extended. But it seems like the last couple of years, builders are trying really hard to get things finished quickly so that they can get paid. And of course, the offset of that is prices have come down. So, maybe if they were able to wait another year or two, things might have balanced out. But again, it's a big function of timing. And unfortunately, that's why I say it's so difficult to time, because you just never know when that's going to be the case.
Yeah, that's why we never try to time anything when we, specifically when we make our retirement projections. And we talk about sequence of return risk and how if you start off when things are in negative territory, both the markets, real estate now we're experiencing, you can run out of money quickly because now you're dealing with reverse compounding. So this is why we keep talking about diversifying. So real estate being part of the overall retirement plan, and maybe we'll kind of wrap this up talking about real estate as a retirement investment, because this is where Ryan and I kind of deal with it on a regular basis, and we're trying to make our projections as well. And I'm talking about specifically rental properties. I'm not talking about principal residence. But what we definitely see is I've had clients come to me who are 10 years away from retirement, wanting to purchase a rental property for retirement purposes. And the one thing that I will say to them is, if you're still going to have a mortgage when you're retired, from a cash flow point of view, you're not going to be further ahead. So it might be a good investment because, to John's point, you're compounding because of leverage at the $500,000, whatever that value is. So the strategy may be, if you still want that rental property, invest in the rental property, but chances are you're going to have to sell that off when you do retire to potentially receive the net proceeds. And taxes have changed a little bit as well, and we'll project all that and we'll illustrate what that looks like. If you have a rental portfolio and by the time you're ready to retire, all you have to worry about is the property taxes, and if it's a condo, you have some condo fees and there's no mortgage on there, then yeah, that definitely works. And then the question is, and I know, John, you've mentioned this to people too, do you want to be a landlord in retirement? Like, do you want to have to deal with the some of the challenges in being a landlord? Some people are fine with it. They'll hire property managers, and that's a great way to kind of manage your portfolio. Others, they romanticize about getting away in retirement and traveling all over the world, and they get the phone call that there's something wrong with their unit, and it's a bit of a problem, and it's disruptive, right? So we'll help people walk through those scenarios to basically ultimately land at, this could be great as an investment to get you to retirement, but then you might have to liquidate it, or you might be able to keep it. And if you have a portfolio of units, you might want to consider property management, because again, if your goals and dreams are to travel to the Bahamas or Europe and whatever else, the last thing you want to do is have to deal with a phone call from one of your tenants needing to deal with something back in Canada. Ryan, do you want to add anything to that as well?
No, you hit the nail on the head. As far as like investing and young, especially young people, I find the pressure to buy the big home as your first purchase is out there, and it's social media, and it's the pressure from potentially family members and whatnot. But I think that the best step is to start small and kind of like build up to the next level. So moving from a condo to a townhouse, and that's my opinion at least, and make the movements and have the equity build up, instead of just jumping right into something that's potentially outside of your comfort zone or budget. So I saw Sonia
Never
smirking for a
advise.
moment.
Yeah, exactly. You saw that. I never advise, jumping outside of your comfort zone and what you can afford.
Mhm.
But if what you can afford is that bigger home and you're going to be working your way there, sometimes it makes more financial sense to just go there because of the realtor fees, the land transfer taxes, et cetera, that accumulate over time. Sometimes it's best just to go from this spot to the larger spot and then downsize and then work your way down, because then you have so much more equity growth as well in that end property than you would in sort of accumulating all these smaller properties. Now, it depends again on the approach. Are you buying the smaller properties, leaving them for rentals, and then moving on? Then it starts to shift in the financial logic. But from a financial standpoint, sometimes it is right to go for that bigger property, and it all depends on your particular situation. So I've seen scenarios both ways. So that's why.
So we're buying Casa Loma next.
Woohoo! They have a great escape room, so let's go do that.
Yeah. So John, maybe we'll wind this down. In terms of the retirement strategy, any comments on what I shared there or Ryan discussed?
Well, interestingly enough, I had a couple who started buying condos in their early 50s, and I thought a little bit early, pardon me, a little bit late to sort of get into something, but it turned out to ultimately work out pretty well for them. And I'll give you the example because it was some time ago we started dealing with each other. They bought the first one, nothing crazy, a 1-bedroom. They bought the second one 2 or 3 years later, and so on. And you're like, well, if you're going to retire in your 60s, why buy that fourth condo? And we kind of worked through it together. And what we had said was this: you buy that first condo again for $500,000 with $100,000 down. I think we worked off of a 3% growth rate, and we were probably a little bit more than that, but let's say 3%. So every year you're picking up $15,000 in price appreciation. And on a 30-year amortization, that $400,000 mortgage is getting paid down, just a linear average, about $12,000, $13,000. So every year you're making about 25 grand. So over a 10-year period, that first condo has maybe built up $250,000 in equity. Let's say they get to the point where they sell that. And let's say they take out their initial investment, less transaction costs and some taxes. And let's say that $100,000 nets out to be somewhere around $250,000. And these were reasonable people. They didn't live a crazy lifestyle. So $250,000 lasts them probably 2 or 3 years. Then they sell the next one, which now with 10 years under their belt, similar situation. So my experience is a little bit different than I think I might have initially thought. And it's funny because I think one of the things I will often say to clients is, as a mortgage broker, no one really needs my help to understand that 3% is better than 4%. People kind of naturally get that. One of the things I try to work to do, just like you do on the planning side, is to understand what does it look like 3 years, 5 years, 10 down the road. And in this instance, surprisingly, it worked out a lot better than I think I might have initially thought had I sat down with it. So the point I make again is, was this their only investment? No. Why did it work out so well? I think it's because they were able to time their exit. So they didn't necessarily have to rely entirely on the proceeds from a sale, because of course that gets you into a situation where it could be tough if you must sell. But at the end of the day, did it work out for them? It absolutely did. And the bottom line is, I think there's no reason it couldn't work out for other people, but the way to give you the best chance of success is to balance things out and, again, be spread across a number of different asset classes and not entirely concentrated in one.
Yeah, it's our challenge is because people definitely get excited with the real estate investment because they can see it, they can touch it, they can smell it. Like it's different than looking at a statement and there's just a bunch of numbers there, right? So they definitely get excited heading into, running towards the real estate side. And for us, it's balance because of these examples that you pointed out. right? So that strategy for that client, the fact that they didn't put all their egg in the real estate basket, they had other resources that they can tap into. So if they were in a situation like the last couple of years where all of a sudden the condo market dries up and they can't sell, they're not in trouble. They still have other resources that they can tap into. That's the responsible planning that people need to do. Unfortunately, many people don't. Right? They put all their money into the bitcoins, or they put all their money into marijuana stocks, or they put all their money into, a single asset class. That's where we find people get in trouble. So, real estate is absolutely important. It does help to soften the volatility in a portfolio. So we definitely encourage people to continue on investing in real estate. And we have a fantastic team to help people navigate through the current situation and future situation. Lots of experience under our belts, right? So first, what I would say is if you're looking for a retirement plan and you want to determine how real estate will fit into it, that's something that Ryan and I can assist with. Working with someone like John, who has the experience on the financing side and also as a real estate investor. Obviously, Sonia as well, as a real estate lawyer and as a real estate investor. So I definitely would encourage people to look for us. I would say the first place to go to is tvhgroup.ca. That's where you'll see all the services that are offered, from mortgages to legal to accounting. So that's another thing too, is if you're going to build a rental portfolio, you're going to need a good accountant. And Dave, our partner, who's not on our podcast today, he has lots of experience in helping clients with navigating the accounting when it comes to rental properties. So any final thoughts, comments? John, we'll start off with you. And if you don't, that's fine.
Yeah, I think we've covered a lot of bases, so I'll leave it at that.
And Sonia, how about yourself?
What this shows, this discussion here shows all the things that you are describing about what we do, but this all happens in the background when we're dealing with clients. We come together to strategize, talk, what are their options, and we bring all this experience and we bring all this care to discussing their particular situations and providing the best strategy, plan, solutions that we feel. And so this is great because it just shows what we do sort of in the background. I always say, have a plan, understand your risks, and know your options by working with seasoned professionals who can provide all the missing pieces and missing information that you may not have even thought about. And so working with these, this group, this team, you can carry out your goals in a manageable way and really grow and achieve that success that you're looking for.
Awesome. And Ryan, how about yourself? Any final thoughts, comments?
If you're 6 months out from your mortgage renewal, reach out to John and the team. If you're planning and looking to make that first step, come talk to us as to what the strategy is of making that happen for you. No matter how young you are, it's a great first step to just start planning those goals. And besides that, Sonia said it, we have a great group that communicates quite well together, and making sure that we're covering all of our bases and that we're not biased in any way like you would get from some other institutions. So,
we are biased. We're biased to do what's best for the client, right?
Sure.
That's our bias, because the bottom line is, and Ryan, you and I have experienced this, working for other firms in the past. If someone approached me outside of this partnership that we have wanting to invest money, my bias would have been, you need to have a portfolio. So if you're going to go to a mutual fund advisor and that's all they offer is mutual funds, and you come up with you have some funds to invest, they're going to either say, well, we're going to put you in a mutual fund portfolio. That's the bias. And the client may say, but I really like real estate. I want to invest in real estate. Well, we have a great real estate mutual fund that you can get into, right? And that's not necessarily what they mean. They want to actually they want to be an active investor, not a passive investor, right? So in working with us, when a client sits down with us and we go through the cash flow analysis, if we go through the behavioral cash flow plan, a retirement plan, real estate, if that's something that you want to do, we don't have a bias against it. It's within the team. That's what we offer. We have the expertise in addition to all the other services that we offer and asset classes, to John's point, diversified. So I want to thank everybody for joining us. If you're listening, watching, please like, share, click, do subscribe, all those other wonderful things. We're on all the social media platforms. Looks like we have another one in the books. And next week, Ryan, you and I are interviewing Jamie Purvis on Monday. So stay tuned for that one. Thanks, everyone.